The electric car area needs a lot of really big trees. You can't charge your electric cars without a lot of new utility poles. Do I think electric cars are coming on? Yes. Would I rather invest in Tesla or invest in the builders of the utility poles? I think I'll take the utility poles. They've got a lot lower PE than Tesla. Hello, everybody. This is Market Moves with Dr. Richard Smith, aka the Doctor of Uncertainty. It's good to be with you all again. It's been a few weeks, and we're wrapping up the last week before Thanksgiving, the last full market week. So things are going to slow down next week, but plenty to talk about over the last few weeks. So let's jump into it. What's been happening? Well, the last 3 weeks, the NASDAQ has soared. Surprise, surprise. This whole walk down from July down into late November, late October, maybe November 1st, and then boom, catching everybody flat-footed, deer in the headlights moment. Usually these go the other way, right? We kind of crawl up the stairs and then we fall down the elevator shaft. But this time we crawled down the stairs and we shot up the elevator shaft. Either way, both kinds of market moves are very disorienting, right? If you weren't in and you're not happy right now, do you get in now? I don't have a great answer for you. I'm just reminding us all how markets work to freak us out, paralyze us, and try to make sense of it all. So hope you were in. We've been talking about the seasonality of November and December. And it's gotten a good head of steam over the last few weeks. The big story this week was the inflation seems to be coming under control. The CPI, the Consumer Price Index, this is 4 different ways of measuring the Consumer Price Index. All of them continue to point downwards. We've got a 2% target. We ain't there yet, but look, things are going down. Phew. And markets like that news this week, contributed to the big rally and rally on top of rally. Also, the producer price indexes. This is the inputs into the goods that we consumers buy. Those have been coming down even totals down below 2% now. So inflation is coming under control or deflation is taking hold. We'll see. Longer term, I'm still expecting inflation. This doesn't happen overnight. It's not a straight shot up to the moon. We've got decades of higher interest rates to come, higher yields, and not surprised to see a downturn in yields right now. And of course, a gradual flattening of the yield curve, which we will talk about again. So here are 10-year yields going back to 2004. We're still at, pretty close to highs for the last 20 years, but definitely saw a downtick from the scary 5% level down to 4.5% or so. Interesting little technical nugget here that there's a gap. These are the 10-year yields. Again, a little different view. Okay, this is the CBOE 10-year U.S. Treasury yield. The prices here are multiplied by 10. So 445.35 means 4.535% yield. And you can see there's quite the gap right here between, say, 4.35 and 4.425. So for any technicians out there, if we see a big gap down in yields and we get an island top here, watch out below for yields or watch out above for bonds. I'm long bonds right now. Feel like I'm a little early, but I still think over the next 3 to 6 months, we're going to see yields come down and bonds rise. So speaking of yields and the yield curve, I know We stretch our brains a little bit each time we get together here, but this is important. Here we have the current yield curve, the blue line here. Okay. For as of November 15th. So again, what are we looking at here? We're looking at the yield at each level of maturity, 2 months, 3 months, 5.5% maybe. 4 months out, you're getting 5.35. 6 months out, you're down to 5.4. 1 year out, etc. 2 years out, it's about 4.9. Okay. We were looking at the 10-year over here. It's at about 4.6. This red line up above is the yield curve from 1 month ago. So what we've seen, what we're paying attention to is the shape of the yield curve. So the shape from 1 month ago, the shape hasn't changed that much. Pretty much all of the yields across the curve have come down together. So rates have come down. The curve itself, the shape of the curve hasn't changed that much, but rates have come down and not surprisingly, stocks have rallied. Okay. We're still in an inverted yield curve. You're still getting more money for your 3 months than you are for your 10 years. If you're going to loan somebody money for 10 years, it's going to take 10 years to get paid back. You want to get a higher annual percentage rate than if you're loaning somebody money for 3 months. Okay. This is abnormal. This is inverted. And it's interesting to look at and to understand a bit better. I actually love playing around. Let me see if I can find it here. I love playing around with this little app here, USTreasuryYieldCurve.com. So let's start over here again. Here's the current yield curve. All right. We're getting 5.53 on our 3-month money. And if we go out here to the 10-year, we're getting 4.53. So then we can go back 1 month and see what it was like a month ago in October. Oops. Let me just fix this. Let's take a look at this one more time. So here we are. The yield curve as of November 15th. We're getting 5.53 on our 3-month and 4.53 on our 10-year. So we still got a 1% gap. Let's pin this here and then let's go back and look at 1 month ago. So again, our 3-month was higher at 5.62 and our 10-year was 4.63. So still a gap of about 1%. I like to walk it back just a month at a time here and kind of look at how the shape is changing. Now, this is interesting. So in September, the 10s were a lot lower and the 3s were higher. So there was a bigger gap there, right? It was more inverted. Let's go back another month. Again, we see more inversion, right? So back in August, we had more inversion and the yield curve is gradually flattening, but we're not there yet. This is called a bear steepening, by the way, when the longer end of the curve is going up instead of the shorter end of the curve going down. So yields are getting higher at the further end of the maturity range of the curve, right? People are getting a little more concerned, putting their money into some longer term investments, but they're not getting out of the shorter term investments. So interesting thing to look at. Let me just show you real quick of what an uninverted yield curve looks like, just so we remember. I think we have to go back to, let's see, I think it was like June of 2022, maybe. Yep, there we go. This is what an uninverted yield curve looks like, right? You're getting, what is that? 1.74 on your 3-month, and you're getting 3.33 on your 10-year. So just in case you forgot, this is what an uninverted yield curve looks like. And we got a long ways to go to get there. All right, moving on. One more little brain stretch here. This is a really interesting chart, has to do with yields, and I wanted to just take a few minutes to explain it to you because, again, it's a very fundamental concept. So we have yields for the 10-year bonds across the bottom here, and right now we're at 4.5 or so. So 4.5% yield on the 10-year, we're right about here, okay? Now this vertical axis here is showing the forward price earnings ratio on the S&P 500. Okay, so what does that mean? If we're down here at 20, let's say, then a stock that's priced at $100 a share is earning $5 a share. Okay, so the price is 20 times the earnings. That's what a price earnings ratio is. These are the estimated earnings for the next 12 months, but that's the idea. A stock that costs $100 has $5 of earnings, has a 20 PE. So we can see as this goes higher, 27 PE, 32 PE, etc. So as yields go up, the amount that we expect, that we accept in price to earnings goes down, okay? Because price earnings are a yield on stocks. That's how much yield we're going to get. The earnings is what we get as shareholders. So if we can get the same level of earnings from risk-free treasuries, why take the risk in stocks? So as the earnings or yields go up in treasuries, the earnings, the yield, the price earnings ratio that we're willing to pay for stocks goes down, right? So here we are at fair value right here around 17. So with a yield, 10-year yield of 4.5%, the fair value for price earnings historically is around 17. Well, right now the S&P 500 is at 19. The rest of the market is at 16. And the Magnificent Seven here at 28 times earnings. So we continue to expect the Magnificent Seven, the S&P 500, to gradually correct down to around 15 to 17. And just a good thing to understand how this works. As bond yields go up, what we're willing to pay in price to earnings for stocks tends to go down. So we need to be paying attention to this as yields rise or as they fall. If they fall more, it's okay to pay a little bit more for stocks. So important concept. Just wanted to make sure we understood it and we dig into it a little bit. I know it's a little bit complicated, but trust me, if you're going to be in investing, you got to understand this. All right. So where are we in the markets today? This is our recession model. We're looking for these times when yield curves invert and then uninvert, and then the S&P crosses below its moving average. And that's when we tend to get these big moves down like we did in 2000, like we did in 2008. And we haven't seen it yet. We've got an inverted yield curve here, right? But we haven't fully uninverted yet. So it can be some time until a recession actually takes hold. I still believe a recession is coming, maybe, middle of 2024, but we'll get there. We have to have about 1/4 of uninverted yield curve before this model would trigger. So it's been a good model. No model's perfect, but definitely something we're keeping an eye on. And again, looking at our basic thesis, when the yield curve inverts and then uninverts is when you get the recessions. Inverts, uninverts, recession. Inverts, uninverts, recession. Inverts, uninverts, recession. We are really inverted right now, way more than we've ever been. The last little bit, we can zoom in here actually. We've actually re-inverted some more over the past few weeks, right? We're going back down. So doesn't look good, but it doesn't seem that the recession is showing up tomorrow. Just another little nail in the longer term coffin. We're starting to see consumers come under pressure. More Americans falling behind on their car loans, 6.1% in September of 23. And this chart goes back to 1994. This is the highest level of defaults on car loans from 94, from the financial crisis in 2008, from the COVID correction into 2020. We are at the highest level of defaults on car payments in the past 30 years. That doesn't seem like a rock solid consumer to me. Meanwhile, we're in the seasonally bullish period of the year, as we've talked about for months now, October, November, December, still expecting to be higher by January than we were in October. And our weekly cycle on the S&P 500 has been performing as expected. And yes, we've had some correction, but it looks like we're back on the rise again. This does not go straight up. This is like late 2025 when this is topping, but definitely have the wind of cycles in our sails. And while we're on this topic of this particular cycle, this is a 41-month or 182-week cycle, I just want to show you something that I've been working on this past week. Very excited about it. Going to be bringing Edward Dewey, the founder of the Foundation for the Study of Cycles, his most important book, published in 1971, Cycles, the Mysterious Forces That Trigger Events, where he first documented this 41-month cycle in U.S. stocks. And we'll look at it in just a minute. And it's coming back into print through Harriman House. One of the premier financial publishers in the world is going to be republishing Dewey's book, which is copyrighted by the Foundation for the Study of Cycles. So we're very excited about that. While I was working on the book over the past month, I've been taking a deep dive on some of Dewey's work. So right here, we are looking at actually one of the charts from Dewey's book back in 1971, where he first identified this 41-month cycle. At the time he was tracking it as 40.68 months. So we're rounding to 41 and showing that this is a clear cycle going back to the 1860s in US stocks, okay? All the way through the late 1940s. And you can see pretty consistently that there was indeed this 41-month cycle in US stocks. This isn't the price of stocks. This is an average and detrended version of stock prices. And then this dashed line here is the 41-month idealized cycle. And you can see it lines up pretty darn good. So now let's bring ourselves forward here into modern times, picking up where Dewey left off in the early 1950s. Again, following our 41-month cycle. It's not perfect, but you can definitely see that the cycle is there. And I want to go down into our own times, in particular here, starting at the 2008 financial crash, the great financial crisis. Look at how we got a top there. Okay, and then we got to go down into this bottom row here. We got a bottom right on time. We got another top right on time. We got a low, not a perfect bottom, but still a low here, into a top, into a bottom, into a top, into a bottom, into a top, into a bottom. So extraordinary that this pattern has been going on in stocks going back to what, 1865. So anybody who says there's not cycles in the stock market needs to read Dewey's book when we get it published in March of 2024 this year. I thought this was super cool. And it's the same cycle that we've been paying attention to all this time here. That is currently, the wind in the sails of the market right now, dating back to spring of 2023. So very cool. Thank you, Edward Dewey. All right. A couple of stories that just caught my attention over the past week that I wanted to share with you. I loved this one in the Wall Street Journal. The electric car area needs a lot of really big trees. So talk about investing in the real, right? These are all utility poles. You can't have electric charging stations, new infrastructure. You can't charge your electric cars without a lot of new utility poles. And a couple of companies that are providing those poles, Stella-Jones out of Canada and Koppers Holdings here in the US, I believe, are doing very well. And these are classic examples of investing in the real. Do I think electric cars are coming on? Yes. Would I rather invest in Tesla or invest in the builders of the utility poles they're going to need to be put up? I think I'll take the utility poles. They've got a lot lower PE than Tesla. And I like it. So we'll check out those when we do a little portfolio analysis here in a minute, but just wanted to bring those two to your attention. And then lastly, this very, frankly, disturbing story. Fake nudes of real students cause an uproar at a New Jersey high school. This is all part of the generative AI revolution. The biggest product that generative AI is going to produce are deep fakes. So these are students at a New Jersey high school taking faces of the teenage girls and putting them on bodies that aren't theirs, and then passing those pictures around amongst teenage boys. This is a total disaster. But this is one of the main applications of what this generative AI technology is being used for today. Look, I have hopes that it's going to lead to enhanced productivity long term, but we can't overlook the absolute destructive force that technology can be. This has been going on ever since social media, and this is social media on steroids, and it's not good. We have to be keeping this in mind as we move into this AI era. I've got nothing against AI. It's a tool. We can use it, but it is also a tool that can be abused, and it will be abused. And unfortunately, most of the monetization models of our internet world today are based on preying upon the weaknesses of the end users of the products, of these devices, because we live in an addiction economy. So please, as the enthusiasm for AI and generative AI builds, just keep this in mind, because this is not the future that we want for our children. All right, let's do a little quick portfolio review. Going to jump over to our tools here. Continuing to improve the FINIAC, aka RiskSmith tools, and excited about the changes that we've been making. Now you can see all the different collections that your stocks might be in that are in your portfolio. So happy with how our portfolio is doing. Going to show you here real quick how you can add some new stocks from a collection, and I can see them right here on this page now. These are all the stocks that are in that collection that are not currently in my portfolio. And so in here we have Stella-Jones and Koppers, which we added, and a few from last time. Lynn, this is a gas producer. Gases like for propane and used in industry, industrial gases. And again, I'm looking for opportunities to add good stocks that I like that are uncorrelated to my existing portfolio. So I sort by correlation here. I kind of scroll down the list. We've got VMC here, which is about 17%, minus 17% correlation. GATX here at about 28% positive correlation. SO, the utility company. And I can play around with these. Let's see COP. If I add COP to my portfolio, what do we got? It actually improves my diversification a bit, up 0.68 points. And it does increase my exposure a little bit, but that's okay. It's not a lot. How about SO? Lowers my diversification score a little bit and raises my exposure. I don't like that. If I'm going to have more exposure, I want to have more diversification. So, not ready to add either one of these to my portfolio just yet. Going to cancel those changes, but really excited about how this is coming along. You can build collections of your best ideas. Follow asset managers that you like, newsletters, whatever your sources are. Okay. Build your portfolios, manage your portfolios, and then see how new collections interact with your current portfolio. And look, not just for great ideas, but for great ideas that work well with your existing portfolio. So that's the whole idea. Really excited about how these tools are coming along. Really excited to share them with everybody in depth in a few more weeks. Keep an eye out for it. And with that, I'm going to wish you all a happy Thanksgiving and look forward to seeing you again on the next Market Moves in a couple of weeks. Take care, everybody.